Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm talking with Meb Faber, CEO and CIO of Cambria Investments. Great to have you on the show.
Great to be here.
So, Meb, you recently launched two new ETFs, a small cap shareholder yield fund and a tactical fixed income fund. I know you mentioned that these are like nothing else on the market today. Can you tell us about the first one of those ETFs, the Cambria Micro and Small Cap Shareholder Yield ETF? Ticker symbol there is MYLD. How does this ETF work?
Sure. MYLD rounds out a suite of three other shareholder yield ETFs we have that we launched over a decade ago and went along with a book we wrote on the topic called Shareholder Yield, A Better Approach to Dividend Investing. And the thesis was dividend investing is a time-honored investing strategy, but really starting in the late 90s, you had to start accounting for how companies started distributing their cash through stock buybacks. In any given year now, stock buybacks outpace dividends. So this holistic focus on cash dividends plus net stock buybacks, which, by the way, includes net share issuance, which is a big deal in our home state of California with stock-based compensation to a lot of these tech companies. Looking at that holistic yield, historically, we thought ended up in a better factor-based portfolio. Now we have over a decade of real-time evidence there. So our SYLD fund is over $1 billion now, has been very successful. We wanted to isolate specifically the small cap area of shareholder yield. So companies below 5 billion, above 100 million, to really focus on small cap companies really underperformed over the past number of years, really over the past decade relative to the market cap index and including things like the Mag 7. So we think the opportunity set right now for these stocks is really looking great.
Super interesting. Meb, are there a lot of small and micro cap companies that have dividends and share buybacks? I ask because whenever people talk about the Russell 2000 or other small cap indices, they note the huge percentage of those companies that are unprofitable.
Part of investing is about what you invest in, but it's also about what you avoid. So the beauty of value investing is, yes, you're investing in cheap companies. You're also avoiding the expensive. Same thing with shareholder yield. Yes, you're investing in companies that have a high shareholder yield, but you're also avoiding the serial share issuers. So the companies that are consistently diluting you with share issuance. So yes, there are a lot of shareholder yield companies. On average, the ones that make it into the portfolio on a buy decision are around a double-digit shareholder yield. In the United States, that results largely from the buyback decision. In other geographies, so we have a foreign development fund and an emerging fund, those tend to be closer to 50-50 cash dividends as well as stock buybacks. So the culture there is a little different, although it's changing in places like Japan, et cetera. And so the sector composition is different. In the US, it tends more towards energy and financials and materials. In our emerging market fund, tech is actually the largest sector allocation.
That's great. Let's talk about your other ETF that you recently launched, Meb, the Cambria Tactical Yield ETF, ticker symbol TYLD. What makes this fund unique?
We wrote two white papers that are free to download. One was called What is the Safest Investment Asset? And a follow-up paper was called T-Bills and Chill most of the time. And the concept was really, if you look at the broad bond space, most people think bonds aren't that volatile. But right now, how many investors are sitting in a 10, 20, I think the long bond went down 40%. Those are equity-like type of drawdowns. And so now all of a sudden we had this long period of zero interest rates. Investors now look around like, oh my gosh, 5% yield. And so they start to move away from T-bills to all these other type of bonds. But it's always been a head scratcher for a value guy like myself, for our company, to say, does it make sense to invest in other bonds if the yield is not compensating you? So hypothetically, what TYLD does is its default is it sits in T-bills. So let's call them 5%. And then it looks at about 10 other bond categories. So longer duration, maturity, US government bonds like 10-year or 30-year. It's got TIPS. It's got corporate bonds, junk bonds, emerging market bonds. It even includes quasi-income securities like REITs, on and on. And it says, hey, look, it only makes sense to invest in these other type of bonds if you're being rewarded with a margin of safety. So if the yield spread relative to T-bills is wide enough, we'll move into those risky securities. So each quarter we look around what's going on in the world. And if the spread's in the top third of history, we'll buy that individual market with each sleeve. When it drops out of the top half, we'll sell it. It's like a value approach to bonds. The crazy part is despite how much bonds have gone down, this portfolio is 100% T-bills right now. Now, a unique feature of both of these funds that's pretty cool, we announced in January, is that we said any fund at Cambria that's below $50 million, we waive the expense ratio until it goes above 50. So both of these funds are currently below 50 million for the early adopters. So the expense ratio is waived. But at some point in the future, one of three things need to happen. T-bill yields need to come down, or the entire curve of riskier bond yields need to move up, or both, before we would invest in these other riskier type of bonds. So right now it's saying, is it time to invest in riskier bonds? Not yet.
Super interesting. And it doesn't look like T-bill yields are going to go down at least anytime soon. Today, we got the latest consumer price index data. It came in higher than expected. Rate cut expectations are getting pushed further back. Do you have any thoughts on that, Meb? What do you think about this latest CPI number? Do you think we're going to get rate cuts this year? And what do you see, in terms of bonds? What's the outlook? Are we going to stick around 5%, or do you see us moving down to 4% eventually if the Fed can get inflation under control?
First of all, who knows? Everyone trying to prognosticate on the future of interest rates has always been a graveyard. But we will say this, if you look at the expectations for all these rate cuts, and then look around in the world and say stocks are at all-time highs, gold's at all-time highs, Bitcoin's at all-time highs, a lot of foreign countries' stock markets hitting all-time highs, a lot of these risk on, don't even get me started on cocoa, a lot of these markets just going straight up. And you say the Fed, to me, their main concern, if you took Fed 101 in college as you were a junior person looking to become Fed chair one day, so what is the one lesson that everyone really got drilled into their head is whatever you do, do not repeat the mistakes of the 1970s, where you had a little bit of inflation. People said, okay, things are conquered, we're fine. And then inflation came really roaring back, much worse. I think that's front of mind for really Powell and anyone else. I don't want to be known as the guy that let the 1970s happen again. So if anything, we think they would err on the side of caution. But as far as when and how they occur, who knows? But for as far as the fixed income investor, it's saying it doesn't make sense to take on this risk yet because they're not rewarding you.
Fantastic. Well, we're going to have to leave it there. Meb, thanks so much for your time.
Great being here.